So in this video, I want to show you how I go about picking trades for the ETF strategy. Today is Friday, it's almost market close, so it's time to roll into the new positions for the trades I have on. And if we take a look at the PA account here, we can see that we currently have 3 trades on, overall looking pretty good today, but we've used only maybe 40% of our margin. So I'm feeling like I'm comfortable adding another trade to the portfolio, and I wanted to walk you through how I'm going to make that choice. So just like you learned in the course, it all starts with this ETF Premium scan. What does this scan do again? It shows us all of the ETFs that have a positive variance risk premium that we're actually able to monetize. For the last 4 years, the VRP is positive and the backtest is also positive. Here is the list of those tickers. Now, according to the strategy and in a perfect world, I would actually want to trade all of these tickers. If the account was big enough, I would literally place all of these trades. But as you can see, this account we're trading together here, it's $10,000. So what are we going to do here? We have to make a choice somehow. Now, there's basically 3 criteria that I use. 2 of them are very objective and right by the book. One of them is a little bit subjective, but it's something that I've sort of adapted over time. The first one is correlation, right? I want to pick something that has a low correlation with the rest of my portfolio so that I get that added bonus, right? The reason we want to add a new ticker instead of just increasing our size on the current tickers is because we get the added bonus of diversification, right? Not everything needs to move the same way all the time. The second thing I look at is liquidity or volume. I want to be trading more liquid things. If I had to choose between 2 uncorrelated things with similar results, I'm going to pick the thing that's more liquid because it minimizes my cost of doing the trades, right? The bid-ask spread that I have to cross. So out of this list, the third thing that I look at is I'll actually just look at the shape of the backtest and the returns themselves, right? If something had like a year ago where it was really great and it's been just downhill ever since, I may be less inclined to trade that over a similar trade with similar liquidity, similar correlation, but let's say, more positive backtest. And I'll give you 2 examples of that here. So the 2 trades that I looked at out of this list that I don't have on right now are XLF and ARK, right? ARK is also on this list right here. So both of these have pretty good liquidity, a pretty solid average VRP return, right? Backtest return, 3.71% for ARK and 6.2% for XLF, right? Huge return there. 63% win rate here on XLF, and for ARK, it's about a 57% win rate. So they look pretty similar overall. And then let's click into them and take a quick look. We can see that ARK, the backtests, they had a huge rally, about a couple of years ago. And since then, there's been a bit of a drawdown, but then really it's more or less been flat. Some periods of making money, some periods of losing money. Honestly, pretty typical of what you see on a backtest. This is not a bad backtest at all. But obviously, we have to make some choices. So as I was looking through them, I took a look at XLF here. We click into it. And check this out. I just take a quick look and I know I like this backtest more, right? Like smooth up and to the right, no major drawdowns, no crazy rallies, just a smooth, steady return that looks really great over the last 4 years. Super happy with this. I definitely want to have something like this in my portfolio, right? IV percentile at the 60th percent. That's cool with me. Average VRP of about 2. Super good. And then a quick check here. I just take a look at the price chart. And this kind of matches what we were seeing in the backtest, right? If we saw, let's say, a huge drawdown in the price chart, but the backtest didn't reflect it, then I'd be like, what's going on here? Maybe there's a liquidity issue, something like that. But this literally matches what we expect to see. We know that when we're short vol, there tends to be a correlation between the various risk premium and like drawdowns, right? We're gonna be paying out when things are having a huge drawdown, and we don't really see that here. So it makes sense that the P&L, the backtest, is pretty smooth, generally speaking. So what I want to do now is come over to the calculators and do this correlation matrix and make sure that XLF is something worth adding to my book. So if I think about the trades I have on right now, I have XLP, XLE, XLV, and now I'm looking at adding XLF. So let's go ahead and put these 4 into the matrix here. And we can see that XLF is like a pretty mid-range correlation with everything. It's not like uncorrelated with them. It's not negatively correlated, but this is something I'm totally comfortable with, right? It's not the same as any of the other trades that I have on, right? I'm not basically having 4 XLFs in my portfolio by doing this. And obviously, just to be clear, I know that when there's a market crash, let's say, everything will become highly correlated. But during the rest of the year, or the rest of like all the time, it's not necessarily going to be that. So I want to be uncorrelated as much and as frequently as possible. And XLF appears to, fit the mold for this. So for that reason, that's the trade that I am going to be adding. So if you have any questions about how I picked this one to add to my portfolio, you can go ahead and send me an email. Use this chat box down here. You can send me a message, reach out in the Discord, or you can leave a comment on this video. Any of the ways to reach out, I'll be happy to get back to you and chat about this trade. And in the meantime, happy trading, everyone. Hope you roll into some great new trades this weekend, and we'll catch you in the future.